GameStop, one guest just said to me, this is outstreeting Wall Street. Is this a risk to stability in the system? How concerned are you as you look at this story about the stability and fragility of the system? Good morning.
Good morning, and thank you for having me on your show. Is this a risk to stability of the system? In my humble opinion, no, it isn't. Clearly, these are remarkable events. They do attract the attention, but they take us back to the first half of the 20th century when retail was extremely powerful in the U.S. market. We're not used to that. This clearly exemplifies the power of technology, the power of communication in a quantum interconnected world. And this return of retail really in the market is something, of course, that regulators are going to have to ponder. But if we look at the core underlying facts, we have basically a hedge fund, and hedge funds were created on the basis that they could short stocks. The whole industry was based on that. If you want a story, you know, the grandfather, the granddaddy of the hedge fund industry, famous Jesse Livermore, who had in his own days at one point cornered the cotton market, was called into the president's office, Woodrow Wilson at the time. And the president asked him, why are you doing this? And he said, I did this because I think I could do it, because I just wanted to try. So there are clearly some mechanical aspects here that will grab and no doubt attract the attention of the regulators. But, you know, if you're a hedge fund and if you take a major short position in an illiquid stock, which is what GameStop was at the time, you certainly also have to keep in mind the mechanics of shorts. And, you know, we can briefly talk about, you know, what shorting entails, and perhaps this is not the purpose of your show. But this, I think, you know, shows a new trend. Retail is back. Whatever the motivation
Xavier?
is, and institutional are going to have to take it into account. Yep.
With this new trend, do you think it's this millennial meme-driven generation? Is this almost like Occupy Wall Street in this day and age?
Well, I think this is what some this is what some members of the press and some observers have said. Ultimately, if you put your own money in a transaction, you know, it might express some emotion, but at the end of the day, you know, you're going to be facing the likelihood of either a profit or a loss. So these are serious transactions. I don't think we should necessarily assume that investors, retail investors who put their money in these transactions are just motivated by some vague political notion of grievance or redress or Main Street against Wall Street. What is true, however, and you see the same dynamics in crowdfunding, you know, millions of very small investors committing very small amounts of money can now move markets. So the negative impact of perhaps making the wrong investment decision at the individual level may not be that substantial. Whereas on the other side, you have institutions who have to face margin calls, potential redemption from investors. So the actual mechanics of how liquidity and the handling of losses is handled is quite asymmetric.
Xavier, time is going to kick in against us in a minute. Can you sum up for me? The risk is this: the regulators step in to muzzle the retail investor. Is there some kind of a moral hazard there?
Well, there's always the possibility of moral hazard in financial markets. This is why we have regulators, and you know, there's an extremely able new head of the SEC coming in to take the position shortly, Gary Gensler, and no doubt he'll have to ponder that. But you know, as regards the financial exposure of each one of the individual retail investors, it probably doesn't amount to very much, and so the asymmetric nature of the risk profile for small retail investors multiplied by millions of such traders
Xavier?
versus, on the other hand, the concentration of risk, I think, is what regulators would want to ponder.